Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
We're back here on the Investor Coaching Show. Paul Winkler along with Evan Barnard, talking money and investing. You're on a roll, Evan. Just keep on, man.
Hey, well, when you're talking about investing, why do people invest in the first place? To make money. Mm-hmm. And when you make money, what typically is going to get snagged out of that a little bit to go to the government?
Taxes.
We got taxes.
Mm-hmm.
And so there was an interview that was from Morningstar. Ivana Hampton was interviewing Ed Slott. Mm-hmm. And, he's
Mr. IRA
kind
man.
of an IRA guru, so to speak. Mm-hmm. And it was interesting. This doesn't happen too often.
Okay.
But I was totally unaware of what they were interviewing him on. And
was he aware of what they were?
He was aware.
Oh, okay.
Yeah. Well,
that's what counts.
He might have sent him a note and said, "Hey, let me come on the show.
Let me tell you about this." Yeah, sure.
We keep our ears pretty close to the ground, but Ivana says the IRS issued a memo about non-grantor, irrevocable, complex, discretionary spendthrift trusts.
Oh, Lord.
NICDS. Yeah, I was like, wow, that's a new one, which is a good thing that I wasn't aware of it, frankly. And so here's the deal: this is a new
some way of getting around.
This is
taxes.
a way to get trust income exempt from taxation.
Okay.
If you follow this complex set of rules for this NICDS, I'm not even going to try to use the words again.
Oh man, yeah.
And so here's the deal: is
I had a dime for every scheme that I'd heard over the course of my career.
The IRS has actually, their general counsel has actually come out with a press release because there's a lot of attorneys and accountants on TikTok promoting this as a way to remove trust income from taxation.
Are you trying to tell me that there might be some bad advice on TikTok?
I'm thinking it could be possible, Paul. It's within the realm. It's within two standard deviations of advice
you go.
on TikTok.
Well, if you want to figure out what mental illness you have, that's a great place to go because you'll find somebody with something, then you can diagnose yourself.
Yeah.
So, yeah.
And so what's happening on TikTok, and this is, this has happened in direct mail in the past. It's happened on social media. This just happens to be in the world of TikTok. Is these attorneys and accountants come on and, well, code section 402.1 says we can do this, but they don't talk about .2 and .3 that say, only if it's Thursday and you're tall, that kind of thing. And then they'll have another snippet. Well, 415B says we can do this, but they don't talk about 415C that says you can't.
Yeah.
And so they build this really strong case for this new complex trust.
And their attorneys, they should really, be right on the ball.
Well, and they're supposedly attorneys.
Elite?
They could be, Eastern European.
Oh, who knows? Yeah.
Voice people,
But I saw the same thing, just historically of things, things that sounded really good.
And, who doesn't want to listen to hiding taxes from trusts? Well, who typically is interested in hiding taxes from trusts? High net worth,
right?
Sophisticated, people that have trusts and a lot of money where
and I deserve the best
taxes.
Legal advice. Yeah.
I want the cutting edge thing. And so, it got so bad and the IRS was starting to see this being implemented that the general counsel came out and basically shot this thing down and said, you're getting half the story and this is not a legit thing. We are, aggressively going after it. And, it's kind of if it sounds too good to be true, as Ed's quote was, it probably is,
Well, it's interesting to me that people were actually trying to implement those strategies because you would, and then it's just, you would think that they would maybe look into it a little bit more. They're high net worth people, that they would get the best counsel.
Right.
I mean, it's not really surprising, but
Yeah, you would think. Exactly.
Wow.
And so that, that's just because you're quote unquote sophisticated, high net worth. And of course, we don't really think any investor is sophisticated that's trying a lot of this crazy stuff.
Right.
We just talked about several examples today. But go with long-term things that, go with benign strategies.
Well,
no one wants a law named after you or your
expert
kid.
Bias, or
attribution bias for one. If I'm smart in one area,
right.
I think I'm smart in other areas.
Yeah, exactly. Attribution bias. That's right. Okay.
And so that's kind of some bad news. But that's just, I mainly bring that up just to be aware if you're starting to search the web for that. Run and hide would be the short answer there.
Yeah.
And then there was an article. It was kind of interesting. I get these questions from clients every once in a while. I would imagine you do too. Hey, I've been at this company for quite a while, and I've got this offer for a lump sum for my pension instead of taking the monthly benefit because whatever, they've been bought out. They've decided to clean up their books and so forth. And so there was an interesting article, and the main point of the article was just here's the considerations that this author took to decide, hey, is this a good idea or not?
Yeah, that's a very common question.
Yeah. And, in his case, it was a $44,000 lump sum pension, or should I keep a $423 a month monthly benefit that starts when I'm 65? And he was about 45 or so, give or take. Well, here's the things to consider. Is my pension so large that if something were to happen, would the Pension Benefit Guarantee Association actually cover my pension?
Sure.
Or is it small enough that, okay, yeah, I'll get the benefit even if the fund goes under? And in his case, his benefit was low enough. It's under the $7,000 or so.
That's right. It wasn't too high.
PBGC covers. And the other was, do I think I'm capable of investing the money well enough that I could get more out of that over time than my pension amount? And it was really interesting. The author at the time said, I'm not comfortable with my investment skill. And I was looking at my Social Security amount, and this would be another guaranteed income. And so I was inclined to take the pension benefit instead of the lump sum. Then he looked at inflation and said, well, that $423
I'm running the numbers as you're doing this.
$600 a month when I retire, And he went through this, and what I typically find, his numbers were a little bit higher, so I questioned some of his math. What I typically find in these...
I'd be curious to hear what his math is because I ran the numbers here, and I'm curious what you come up with.
Well,
what he came up with,
I typically find that if you get about a 4.5% up to maybe a 5% rate of return...
internal rate of return.
...on a portfolio, most times you're going to beat the pension benefit by taking the lump sum. Just when I crunch the numbers... Now, interest rates have really changed, and so lump sum numbers have fallen off a cliff. And so I haven't done any of those recently. But where he came down, and then you can share the numbers, was I can't leave my pension to my kids. And if something happens, I can leave the lump sum to my kids.
And that becomes a lot more
there's
important
more
to people as they get older.
Behavioral stuff that factors into financial planning than really most people think.
No, I think that's a really good point because I find that people as they get older, you have these books out there.
Yeah.
Die with your last check bouncing or whatever.
I have a few of those clients.
And, I'm spending my grandkids and my kids' inheritance. You hear that kind of thing. But I find in reality, people's frame of reference changes as they get older because they start to think legacy. They start to think leaving something to be remembered by. I remember, just my grandfather, that was a big deal for him. My parents, it was a huge deal for them. And, it was just they wanted to do something that would be a legacy. And some people only do it just for charities. It may not even be your kids. It may be that you leave something and you want to leave it to some, school or charitable or a church or something that was important to you. So that becomes really important. But I just took your numbers. You said 440,000, right?
44,000.
44,000
was the lump sum offer.
Oh, I thought it was 440.
No, 44,000.
Okay, and so it was 423. I thought it was 423 per month. Okay,
it is 423 per month at age 65. He was going to get 44,000 today.
Oh, okay.
And he was around 45-ish or so.
Okay, so he had 44,000. So you got about a 20-year period that this money is going to be invested at.
Yeah.
And then and then it's going to kick off $423 a month per month at age 65 is what's going to happen. So it's going to kick off a little bit over $5,000 is what you'd look at. You say, okay, so how much is it going to kick off? About $5,000 a year. And then you go, okay, so if I had a rate of return, let's say bonds are paying somewhere in the neighborhood of well, you just had the Social Security COLA that just came out.
Right.
I don't know if you noticed that. It was 3.2%. 3.2%.
Yeah.
Yeah, 3.2% is the new COLA for Social Security, cost of living allowance. That's the inflation increase that's going to happen with Social Security. So I look at that and say, well, what if bonds that I invest in have a 2% return above, inflation? And that wouldn't be unusual historically for about 2% return. If you're looking at Treasury bills, you'll hear me say like 0.4. Mm-hmm. But if you're taking a little bit more risk, you're going longer term bonds, it might be 2%. So let's say that it's about 5.2% rate of return is your internal for your bonds. And you're looking at age 65, maybe a life expectancy of 20 years. So how much money would you have to give me right now to give me a payment of that? You'd have to give me about $62,000.
Okay.
So it would be somewhere in
future dollars.
Right.
Yeah.
Right. So you'd have to give me about $62,000, and for me to say to you, if I were an insurance company, if somewhere in that neighborhood, if my internal rate of return on my portfolio is 5.2%, you'd have to give me $62,000 in order for me to guarantee that I would pay you $5,000 approximately. Okay. Just to use a nice round number. So now if we say, well, here's the deal. You got $62,000 is the ending account value.
Right.
Over a 20-year period, right? And you got $44,000 is what the value is today. So that's the present value of it. The future value is going to be 62 at 65. What would be the internal rate of return over 20 years? It'd be about 1.7% rate of return.
Right.
It's horrible.
Yeah. And if you, let's just, and I don't know if he was exactly 45, but let's say he was.
But close enough. I think the point of this is just this is how you do the calculation.
Yes. Yeah. And even if you just use a rule of thumb and say, okay, 7%, I've got 20 years. So let's just say it's a 7% growth rate on a diversified portfolio. Mm-hmm. That means it doubles twice before he gets to 65.
Yeah.
And so that 44 goes to 88,
goes
to
170,000.
176.
Yeah, you're about 170,000.
And you could spin off 8,000 a year instead of 5,000 a year.
Yeah, and I think but
you have to crunch the numbers. You can't just go with all of these things. Interest rates affect it. Mm-hmm. You literally have to crunch it each time.
Yeah, I think, and this is it. So these are decisions that you make not in a vacuum. You do it with knowing a little bit about market returns, what the portfolio is invested in, PBGC numbers. What is it going to be guaranteed? Is it not going to be guaranteed? And I've had stories about that before that I've told.
Is my spouse aware of this conversation?
Oh, yeah, exactly. The spouse has to sign off on it. Yeah, sure thing. So a lot of things to be aware of. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.